So, good afternoon, everyone. Welcome to the panel. It's a pleasure to have you all here. Testing? Oh, now it's back. So, my name is Eduardo. I'm a young scholar, and I was given this huge honor of chairing this amazing session today. I was taught to be very strict on time, so I'll be very brief. How this is going to work is every speaker will have around 20 minutes to speak. If everything goes well, we'll be left with around 20 minutes or half an hour for discussions. The first one to speak is Dr. Bishop Akog. He's a board member of the Northern Patriots in the Research and Advocacy. Later we'll follow with Dr. Francisco Perez, who is an assistant professor at the University of Utah. And last but not least, we'll have a talk from Dr. Radha Upadhyay, who is from the Institute for Development Studies at the University of Nairobi. So I won't take much of the time. Please, Dr. Akogo, the floor is yours. Thank you. A round of applause.
Okay. So all protocols observed. My topic is designing sovereign payment systems in Africa, the Pan-African payment system, and the challenge of regional trade in local currencies. In life, and especially in development, you are not independent if you are not in ownership and control of at least 5 things. First is your head, education. Second is your currency. Third is your food. Fourth is your clothing. Fifth is all of them together, your destiny. And I've been asked to talk about only one of them, which is the currency part. So I'll be looking at the problem, possible solution, the architecture of PAPs, challenges, parallels that have happened on the continent, what lessons we can learn from it, and then what are next steps going forward. Intra-African trade has long been constrained by a paradox. We are near, yet far apart. See. So in spite of the geography of nearness, we are still depending on other currencies to be able to pay, even when you are buying granules next door. At the heart of this fragmentation is the persistent reliance on foreign currencies, especially the US dollar and to some extent the euro. This dependence introduces costly inefficiencies, reduces monetary sovereignty, and entrenches Africa's dependence. The proposed solution, trade liberalization with our financial infrastructure, is insufficient. So let us explore the potential of the Pan-African payments and settlement system to address these gaps by enabling a real-time cross-border settlements in local currencies, thus supporting the intra-African trade and the broader objective of continental economic sovereignty. So the research question is, can PAPs facilitate inter-African trade in local currencies, enhance monetary sovereignty, and serve as a stepping stone towards a post-neoliberal vision of regional integration? That is the question that we need to answer. Now, to answer that question, we drew on case studies comparative regional experiences, and content innovations in financial technology, particularly blockchain and smart contracts, to evaluate whether PAPS can evolve from a technical intervention into a strategic economic instrument in emerging multipolar world. You see, because we have been bipolar for a long time now, this world is becoming new. But we have to be reminded of a number of legacies. The legacy of monetary fragmentation in Africa. Our current monetary geography is a product of colonial legacy, post-independence fragmentation, and externally imposed economic orthodoxy. While geopolitical independence swept across the continent and we all got these flags and national anthems, very little happened after that. Despite decades of regional cooperation and institutional efforts, most cross-border transactions on the continent still pass through our former so-called colonial masters. I make a call here and it has to go to either France or to the US before it comes to you. The colonial monetary architecture persists in various forms, especially pronounced in the CFA zone. We all know that. While the proponents argue that it gives you monetary stability and certainty, others say it takes away you don't control your monetary and thus your fiscal policy, and therefore erodes your sovereignty. And those with so-called monetary sovereignty also suffer the problem of instability in their currencies and their inability to be able to meet their import needs, as well as the disease of borrowing foreign currencies and therefore running into huge debts and running huge deficits without the discipline of an international arbiter. Therefore, most traders and government default to the US dollar. Efforts to establish regional monetary unions did not start today. We've had a number of them. We have the Economic and Monetary Community of Central Africa, CEMAC. And then in West Africa, we have UMOA. Initiatives like the West African Monetary Zone, WAMS, which aim to introduce a single currency called the ECO. I'm sure we all know what has happened to the ECO. Countries, sometimes they struggle to meet the convergence criteria. They meet 2, 3, the next 2 years they slip back to 1. Therefore, the Pan-African payment and settlement system is seen as part of the solution to resolve all these payment problems, especially the fact that we are going to be able to use our local currencies. So I buy from Burkina Faso goats and sheep and cows and beans and onions, and I can pay in cities. They buy banana, plantain, yam from Ghana, and they can pay in their currency. PAP's origin, architecture, and objective. The Pan-African Payments and Settlement System is an ambitious initiative developed by or under the leadership of the African Union and the African Export-Import Bank, AfriBank, in collaboration with the African Union and the African Trade Area Secretariat. It was officially launched in 2022 and has been piloted in Ghana and Nigeria at least. At its core, it is a multilateral real-time gross settlement system that connects commercial banks, central banks, payment service providers across the continent. It enables one buyer in one country to pay for imports in their local currency. So we have three layers. First, we have the commercial banks that initiate payment instructions and receive settlements notifications. We have central banks that serve as the national clearing agents and settlement anchors. Then we have Afri-banks that acts as the regional clearinghouse, offering liquidity support and acting as a guarantor of transaction completion. Objectives and strategic vision. The broader objective of PAPs go beyond mere technical efficiency and include the following: to reduce dependency on foreign correspondent banks, encourage the use of local currencies, promote financial inclusion, strengthen regional monetary policy coordination, and serve as a fundamental infrastructure for future innovations on the continent. As I said, this has been piloted in Ghana and Nigeria, and the results are encouraging. But other regions in the global south have also attempted to build similar payment systems. Notably among these are Sucre system in Latin America and the Chiang Mai initiative in East Southern Asia. These provide valuable lessons for us. Now, to take lessons from these initiatives I've mentioned, in terms of institutional governance, the Sucre, the Latin American one, was politically unstable, whereas the Asian one was technocratically managed. PAPs must maintain neutrality and transparency. That's a lesson for us. In terms of liquidity support, the Latin American one was weak, but the Asian one was strong with a strong reserve pooling. So PAPs needs a robust liquid line via Afri-Bank or AMI. Participation base, the Latin American was ideologically aligned, but the Asian was broad economic cooperation. So PAPs must learn to be inclusive and bring on board all the regional development organizations. In terms of technical infrastructure, the Latin American one is very nascent, but the Asian one is highly formalized. So that teaches us that we need to emphasize technical scalability, regional integration linkages. The Latin American one is weakly integrated, but the Asian one has strong trade and financial linkages. Therefore, that's our need to link it with the African Free Trade Area Secretariat. To evaluate the practical viability and challenges of implementing PAPs, we need to also look at ECOWAS and the East African Community. And these two case studies also have lessons for us, as well as the pilots that are mentioned for Nigeria and Ghana. But challenges persist. Currency volatility. Non-CFA currencies are prone to devaluation, raising settlement risk. Regulatory misalignment. Differences in anti-money laundering, know your customer, and capital control hinders seamless interoperability. Trust deficit. Legacy of monetary colonialism leads to hesitancy among some policy actors regarding supranational financial systems. Nonetheless, the ECOWAS experience shows that PAPs can function as a bridge between existing national systems and long-term monetary integration. Lessons from ECOWAS and the East African Currency arrangement in terms of ECOWAS is mixed, CFA plus non-CSA zones. As for ECA, they are more uniform. But what we can learn from this is that PAPs can function without necessarily waiting for full union. Digital infrastructure, moderate and varies from country to country in ECOWAS, but in the East African one, we have strong mobile integration, especially M-Pesa. The high readiness for PAPs integration, meaning that we can learn from this. Many of our citizens, the penetration of mobile phone is very high. Pilot success, Nigeria and Ghana are awaiting expansion. So we can ride on the back of that. Towards a continental monetary infrastructure, the successful implementation of African Continental Free Trade Area hinges not only on elimination of tariffs and non-tariff barriers, but also on the development of a coherent integrated continental financial system. In this regard, PAPS is not merely a technical innovation, it is the cornerstone of institutional architecture. Policy roadmap and scaling up. We need institutional development and legal integration, technical and financial infrastructure, and governance and stakeholder engagement to ensure that we bring all on board, including the active private sector. Milestones and timelines. We expect that 2026-2027 full regional organization endorsements. So we have legal convergence across all regional coordinating organizations. Then establishment of African Monetary Institute by 2028, a Pan-African technical supervisory body operational. Then full integration with mobile and seamless payment flows 2029-2030. Foreign exchange pooling and reserve stabilization fund 2031. Near universal adoption 2035. Risk and mitigation, sovereignty reluctance, emphasize local currency control, decentralized governance model. Technology inequality, provide infrastructure grants and technical support to smaller and weaker countries. Regulatory misalignment, AU-led harmonization task force and legal support teams. Low business adoption, incentivize usage through transaction rebates and digital training. Cyber attacks, let's adopt blockchain and smart contracts. Thank you very much.
Thank you, Professor, for this rich presentation. Since we are lacking some time, I will move to the next presentation. So, Francisco, the floor is yours, Professor. Yeah. Can someone put Professor's presentation, please?
All right. Good evening, everyone. Thank you so much for being here. I know it's been a very long day. First, I'd like to thank the organizers, Ndongo, and the entire team behind Idan for this wonderful conference, for bringing us all together. Secondly, I'd like to thank my wife for taking care of my kids this week so I can come to Senegal. Let's remember that economics is all the work that we do, paid and unpaid. So I truly appreciate her and would like to bring her spirit into the room. 3, I'd like to thank again all of you. I've learned a lot already these last few days. I've taken a lot of notes, as you can see. And it is truly an honor to be here. I always tell people I studied economics not to talk to other economists about Africa, but to talk to Africans about economics. So thank you all for being here. It is a great honor to present this work in front of you all today. So my name is Francisco Perez. I am an assistant professor of economics at the University of Utah, and I'm here to talk to you today about why monetary policy in the West African CFA zone is not working, how we know that, and what we can do about it. So, for those of you who are not familiar with the usual setup for an empirical economics paper, it has a very standard formula. So I'm going to introduce the topic, I'll give you one slide on literature review. I'll go very briefly and painlessly through methodology. Don't worry. Only 1 or 2 slides on data and results, and we'll spend most of the time talking about what these results mean. So first, I didn't have to convince all of you that this work is important, but in case you doubt me, the first point to make is if you combine the entire West African CFA zone, it's about 140 million people, which would make it second only to Nigeria on the continent in terms of population, right? So these countries may seem small, but the region is a big deal. Secondly, effective monetary policy is essential for macroeconomic stability and development. It is necessary but not sufficient for development, but it is absolutely necessary. No one country has ever developed without an effective monetary policy. Yet the literature shows that for many low-income countries, monetary policy does not work. What do we mean by not work? What we mean is when you raise interest rates, raising interest rates is contractionary monetary policy. That's supposed to bring output and prices and employment down. If you lower interest rates, that's expansionary monetary policy. That is supposed to raise prices, output, and employment. We do not have reliable evidence that that happens for many low-income countries. I've done previous work looking at this same question at a macro level, right? So GDP at the national level, inflation at the national level, and then the policy rate, which is the same for all 8 countries. There we show monetary policy doesn't work. Where exactly is the breakdown, right? So the point of this paper is, can we identify where in the chain of monetary policy transmission the process breaks down so that we can fix it, right? So the research question for this paper that we'll be discussing for the next 15 minutes is, does the bank lending channel of monetary policy transmission function effectively in the West African Economic and Monetary Union? I'll explain why we focus on the bank lending channel in a second. So again, I'm assuming most of you already know this and probably know more about the CFA franc than I do, but for those of you who are new to this part of the world or come from other parts of Africa, the West African Economic and Monetary Union is formed by 8 countries: Benin, Burkina Faso, Cote d'Ivoire, Guinea-Bissau, Mali, Niger, Senegal, and Togo. All share the CFA franc. There is a second CFA franc zone, including 6 countries in Central Africa. We will not be discussing them here today. Other key feature is they have a fixed exchange rate to the euro, which is created, this CFA franc was established when the IMF was created in December 1945. It has been tied to the French franc ever since, and when the French franc was converted to the euro, the CFA franc has since been tied to the euro since 1999. In monetary theory, there are theoretically 4 channels through which policy rates set by a central bank can affect the overall economy. There is the interest rate channel. So for example, I'm an American, I have a mortgage. When the Federal Reserve lowers interest rates, that is supposed to make it cheaper for people like me to buy homes, right? There's the bank lending channel. When the central bank makes it cheaper for banks to borrow, they are supposed to pass on those cheaper borrowing costs to households and businesses in the CFA zone. There is the balance sheet channel. When interest rates go down, usually stocks go up, people feel richer, they spend more money. And then finally, there's the exchange rate channel, right? So usually lowering interest rates tends to devalue the currency. Raising interest rates attracts inflows, which tend to lead to appreciation. We argue, and here I'm borrowing from much of the literature that says really only the bank lending channel is operative, most likely in a place like West Africa. Why? Because there are missing or thin markets in bond markets. So secondary bond markets are quite small, very few trades, very few actors. So you want a deep liquid markets where you can go in and buy a bunch of bonds without changing the price. Equity markets are quite limited. There is a regional stock exchange that is quite small. And then finally, we do not have the same kind of real estate market as exists in the US. Maybe possibly a good thing, given the history of housing markets in the United States. right? So the effective transmission requires arbitrage across securities, time horizons, and asset classes, conditions that largely do not exist in many low-income countries, right? There are not, the same number of financial products, everything from hedge funds, mutual funds, all of that exist here, either in many countries, either not at all or in very small kind of embryonic form. So, a very simple model here. What do we talk about when we mean the bank lending channel? So in this case, a central bank, the Central Bank of West African States, la BCAO, sets a policy rate. That is supposed to affect some kind of money market rate. In this case, we'll be defining the money market rate as the rate at which commercial banks can borrow directly from the central bank. And then that is supposed to affect bank lending. Again, assuming that if the central bank makes it cheaper for the commercial banks to borrow, that they will pass on those cheaper borrowing costs, those lower interest rates to their customers, and vice versa. If interest rates rise, they make it harder for other people to borrow, and then from bank lending, that should affect aggregate demand, i.e. output and prices, GDP, right? So my paper here, we're gonna focus on these first two stages. Again, here still, for this transmission mechanism, for this transmission channel to work, you would ideally have deep competitive financial markets where banks, because of competition, do pass on those cheaper borrowing costs. Once again, the problem is, you could argue in much of the CFA zone and many low and middle income countries around the world, those conditions do not exist. So this is, my contribution here, what I'm trying to add to the stock of the world's knowledge is first a structural analysis of the bank lending channel in West Africa, right? So looking within that black box of transmission to figure out, again, where's the breakdown? Two, I'm looking at the BCAO's main policy rate since 2008, which is the minimum bid rate, the rate at which liquidity auctions, weekly and monthly liquidity auctions begin. And then my regressions include a few bank level characteristics, that a few other people haven't not used before. I'm looking at ownership. So is this a foreign owned bank? Is this a domestic owned bank? Or is this a public or state owned bank? And then a few years ago, the BCAO started designating some institutions as either national or regionally systemically important financial institutions. So I look at, does any of this bank lending or response to policy rates depend on ownership or this sci-fi designation? Previous literature generally finds little evidence of effective monetary policy transmission. There's been several WAMU-specific studies. Kakunopuko put out one, over 20 years ago. Generally, the consensus is little evidence of effective monetary policy transmission. The IMF did a meta study about 12, 13 years ago, and they find none of these studies finds unambiguous evidence of large and statistically significant effects of monetary policy innovation on both aggregate demand indicators. So I expected not to find an effect, and what I found was no effect. Two-stage empirical framework. So first I look at, to what extent does the policy rate affect the money market rate, right? So the money market rate regressed on the policy rate and a previous version of itself, right? And then on stage two, I look at the change in credit, right? So this is bank level. The money market rate is the same for all banks in the region. That only varies by time. Credit, however, does vary by country. So I is the bank, J is the country, and T is the year, right? So if you're looking at Société Générale here in Senegal in 2011, that would be I equals Société Générale, J equals Senegal, T equals 2012, right? In there would also be Société Générale au Burkina Faso, Société Générale au Benin, different years. Right, and the idea is, to what extent then do banks actually respond, does bank lending actually respond to changes in the money market rate? Again, we expect if if this transmission channel worked correctly, you would expect that alpha 1 would be positive, right? Higher policy rates would lead to higher money market rates. Those two should move in tandem. And then beta 1 should be below 1, right? Should be below 0, which means higher funding costs would lead to reduced credit, right? So we imagine if interest rates go up at, the interest rates at which banks can borrow from, the commercial banks can borrow from the BCAO, then they will lend less. I use a system, general method of moments estimator. Most of you probably don't know or don't care, but in case you need to know, it is a system GMM. Why? It addresses unobserved bank level heterogeneity, or at least it's supposed to. Hopefully handles potential endogeneity of regressors. If you've ever listened to economists talk, you know they are obsessed with the term endogeneity, so this is my attempt to allay that concern. And it generally is what we use for these kind of dynamic panel structures. It uses first difference and level equations. So, overview, I put together an unbalanced panel of 136 banks across all 8 WAMU countries from 2011 to 2022. That's the data that's publicly available through the BCAO. So I have about 1,800, almost 1,900 bank year observations. Bank level variables, credit growth, return on assets, capital buffer, size, the liquidity ratio, ownership type, sci-fi status, right? All of those vary by bank. And then a few variables that only vary by country. So the BCAO minimum bid rate, obviously the repo rate, the money market rate, interbank, inflation, a measure of the output gap, and then 2 measures of institutional quality. So the results I'll show you have 2 columns because I use 2 different institutional quality measures. As many of you know, those are quite subjective. So I try to use more than one for robustness reasons. This is the policy corridor, right? So the dashed line is the minimum bid rate. It is the floor on the money market rate. The repo rate, technically the marginal lending rate, is that solid black line. It is the ceiling of this policy corridor. In the middle, that dashed line in between the two is the money market rate. Again, that is the rate at which commercial banks can borrow from the BCAO. And then the line above, the dashed line above, is the interbank rate. That is the rate at which commercial banks borrow from each other. However, the banks that do borrow reserves in this region borrow more from the BCAO than they do from each other, which is why I focus on the money market rate and not the interbank rate. The interbank rate is the lower dotted line. The solid line is the bank submissions, their bids, how much money they wanted to borrow from the central bank. Until the pandemic started, the BCAO had a limit, which is that dash line that you see. And then in 2020, they lifted the limit, which is why these two are now the same. I'll go through the results quickly. I obviously only will show you a bit of the regression results. Essentially, the BCAO's minimum rate has no effect on the money market rate. In fact, if you believe these numbers, the effect is negative, which is not what we would expect. However, the repo rate does seem to have an effect on the money market rate, which tells me that it is the ceiling and not the floor that matters for liquidity-constrained banks. So in this case, what this is telling you is, were the BCAO to increase interest rates by 100 basis points or 1%, you would get a 44 basis point to 70 basis point increase in the money market rate. So we'll consider this incomplete transmission. The real kicker is here. So does the money market rate have any effect on growth, on credit growth? And the answer is no, right? So this is really where we see the breakdown. Does not seem that the banks in this region, their lending decisions respond to money market rates. Why is that? So I would argue, again, thin financial markets, limited secondary markets for government securities, shallow interbank market. There's plenty of evidence that the banking sector in the region is oligopolistic. There isn't much competition. Many people argue that credit is supply constrained. There's high borrowing costs compared to other regions, and banks tend to focus most of their lending on short-term, low-risk borrowers. Generally, they like lending at very short terms to governments and big companies. Not much in the medium to long term, and very little to the small and medium business sector. And then many people argue that the banking sector here is segmented. There's a large number of very small national and regional banks and a small number of very large foreign-owned banks. And the two do not usually talk to each other. The big banks can either borrow, if they need liquidity, they're either excessively liquid or can borrow from their parents in Europe. So if you remember anything else about this presentation, this is what I would like you to leave with, right? So how do we interpret this fact? Most economists would not disagree with me. Again, the literature says most monetary policy is ineffective in low-income countries. The question is, what do we do? The IMF, or the orthodox view, is, as always, restrain your activist impulses, which generally means maintain the status quo of inflation targeting and the peg to the euro. In essence, they ask the people here of the CFA zone to wait for financial markets to develop to the point where this form of indirect interest-based monetary policy becomes more effective. Just wait for the markets to develop to the point where this stuff works, is their answer. I think the question of African economic development is too urgent for us to wait. I do not think that monetary policy is completely ineffective or impotent. The problem is policy design, not inherent impotence. Such a neoliberal framework may not be appropriate for the global north. I would argue it is absolutely not appropriate for low-income countries. The answer is, instead of waiting for reality to meet the instruments that you have, adapt your instruments and targets to the reality you have to deal with. So I would argue it's better to adopt development-oriented policy targets and agree with Taran Kemraj when he says pessimism about monetary policy in low-income countries stems mainly from studying monetary economics through the prism of models intended for the advanced capitalist economies. So my recommendations are: move beyond inflation targeting, pursue a real development-oriented goal, employment growth, capacity utilization, or credit expansion in priority sectors. If you are going to have a fixed peg to the euro that already does a lot of work to ensure price stability, why are you using two instruments, both the exchange rate and the monetary policy rate, for one target inflation? Generally, we advise one instrument, one target. And then finally, like many of the people here, I would argue the BCAO should adopt direct monetary policy instruments similar to those it used to employ, which means direct and subsidized credit for priority sectors as part of a regional industrial policy, and expand regional development banks which are more willing to lend and medium and long term. So once again, what did we find here today? Again, the first comprehensive analysis of bank lending channel in the West African Economic and Monetary Union. Weak transmission at stage 1 from the policy rate to the money market rate. Complete breakdown at stage 2 from the money market rate to bank credit. Conclusion: indirect market-based monetary policy is ineffective. Implication: change the instruments and targets, move towards direct monetary policy with a real developmental goal. Again, this effective policy is critical for African development. Thank you all so much.
Thank you very much, Dr. Paris. Now we move to the presentation of Dr. Radha Upadhyay. The floor is yours.
I'm from the University of Nairobi, and whilst this presentation is uploading, maybe I can just ask many of you to do a small exercise, to maybe just get up, stand up. But how many of you have heard of when you think of Kenya, you think of mobile money or M-Pesa. Maybe you can raise your hands. Yeah, so many of you know about financial inclusion, and Kenya is often seen. Hello. Okay, so Kenya is often seen as the cradle of mankind, but also the cradle of mobile money. My presentation today discusses another stage, not the payment stage, but the digital credit stage. And digital credit, and this paper, I developed it together with Karen Weitzberg of Queen Mary University. So digital credit is the idea that not only can you transfer money using phones, but you can get a loan on your phone. And this is just an example of how, using a phone, you kind of apply and you're given a loan. M-Pesa was launched in 2007 in Kenya, and in 2012, this digital credit was launched. The first digital credit product was something called M-Shwari, which was formed as a partnership between a bank at that time called CBA, now NCBA, and Safaricom. Then there have been many other digital credit providers, including kind of standalone fintechs called, for example, Tala, and then other bank fintech partnerships or Safaricom partnerships. And the latest one is a partnership between Safaricom and two banks, NCBA and Equity Bank, called Feliza. Now, let me give you a bit of background. Like I said, many people here put up their hand when they said, have you heard of M-Pesa? The issue is, whilst mobile money fulfills the payment function of finance and has led to financial inclusion, though there are debates on the quality of that financial inclusion, how much impact it has, I'm of the view that whilst it hasn't been transformative in terms of actually creating kind of real poverty reduction, the payment function allowed people to manage risks better by actually harnessing their own networks. So it allowed Kenyans to do what they were doing anyway, like using their families and friends to manage risk. The bigger issue is digital credit. Now, digital credit fulfills the intermediation, the lending function of finance, but there's a lot of evidence of over-indebtedness, and it can really be now considered a form of financialization. To bring this home, as academics, I'm sure many of you will realize that our work is actually very removed from the real world, and whilst we all want to have some sort of policy relevance impact, just the nature of academic research means that we're a bit far. But during the last election, when President Ruto was being sworn in, he talked about the ills of digital credit in his inauguration speech. So for me, it was a real, kind of almost a surreal but also interesting moment that what I was researching was actually in an inauguration speech. But in this paper, what we argue is that the research needs to move beyond just the ills of fintech's rollout across the African continent and focus on regulatory measures that can better protect users and limit their exploitation. And our research focuses on the Kenyan government passing a landmark act to regulate digital credit, the CBK Amendment Act of 2021. Now, this act was in response to the evidence of over-indebtedness. In our approach means we acknowledge the agency of African institutions, and we think it's particularly important to not just see this financialization as a one-way vector from global north to global south, but within an African country institutions. And our research questions, what are the key challenges of digital credit? Why was the regulation needed? What was the process of regulation and what shape did the regulation take? And how did the Kenya's political economy factors shape the regulation? So I'll give you the punchline. So we argue that the regulation that came out reinforced the sort of false binary between banks and non-banks. As you saw in the introduction, the initial, like a lot of the digital credit products are partnerships between banks and our biggest fintech, Safaricom. But there were a lot of non-banks, fintechs that were also offering digital credit, and the focus in the regulation was too much just focused on those standalone fintechs. We use a combination of methodologies to show that, for example, discourse analysis showed that the media was so focused on these fintechs, these new fintechs, that it reinforced this false binary. And using business power theory, we argue that the shape of Kenya's regulation was heavily influenced by the structural power of Safaricom and banks, and I'll go later into defining what structural power means. We also argue that, credit is just hard to regulate. I teach a course on finance and development, and what I kind of discuss with my students is there's a reason why we have usury laws in all the oldest religions. This idea that lending to micro and to poor people is kind of an easy solution to some of the problems is just kind of, it's a time immemorial problem. So it's almost not surprising that we had these issues. And also the digital credit kind of blurs the distinction between banks and non-banks, making it hard to regulate. I'll just explain a bit of business power theory. So I think many of us are kind of very aware of the role of private sector, private people, private institutions, private businesses using what we kind of think of as lobbying, corruption, to influence government decisions. In business power theory, this is referred to as instrumental power, this kind of obvious efforts to shape regulation. Structural power it takes a different lens where it's recognized not only in the global south, but in the global north. Finance and financial actors continue to have significant strength in influencing regulation, but in the absence of instrumental power, without any sort of obvious lobbying or corruption. Structural power instead recognizes that capitalists do not need to directly influence regulation, and large companies and capital holders have influence over politics because they do two things. They create jobs and they pay taxes. So we also complement this structural power with this idea of ideology, which other authors have used to explain the shape of regulations, for example, environmental regulation. So we use this combination of factors, the media discourse analysis, structural power, and ideology, to show that though there was an intention that this CBK Amendment Act would rein in digital credit providers, by focusing only on the new fintechs and what is often referred to in Kenya as the previously unregulated, it missed an opportunity to truly make a difference in the regulation of digital credit. Taking a step back now, what was the problem? Like when digital credit came, it was an idea that, people are able to use mobile money to, balance their risks. Maybe if they're able to borrow, and if the borrowing is through a tech company, will reduce all the costs of these microfinance agents and there'll be low barriers. Instead, what was found is many of these continue to have very high interest rates. Now, it's important to remember that they're very short-term loans. But if you do what's an APR, which is a yearly rate, which is an estimate, you have 49%, 91% APR, and some a stunning 442%. And this is not my estimates. These estimates are from an organization that actually really is pro-financial inclusion, but realize that digital credit is leading to more harms than was envisaged. Also, what happened is when people started using these products and defaulting, they didn't realize that they would be blacklisted in the Credit Registry Bureau. So big reason why President Ruto mentioned digital credit in the inauguration speech is he promised Kenyans who've been blacklisted that I will do something about this. There were a range of data governance issues. People didn't realize it was so easy to borrow that when you tick, you're actually saying, yeah, I'm allowing you to contact all my contacts on my phone. And then what people initially appreciate about digital credit is that they felt it was anonymous, they were getting credit quickly. And the next thing they realize when they haven't paid is every single person they know is being called to say, pay up for Radha. Radha's defaulted. Can you pay up for her? And there is a lot of evidence of over-indebtedness. Now, default on a loan is not necessarily counted as over-indebtedness, but there are estimates that show that when you don't have a meal to pay for the loan, that's considered over-indebtedness. And there is evidence within our FinExcess that people have been either selling assets, borrowing, or reducing food expenditure to pay back these digital loans. And this is just some of these examples of over-indebtedness. So let's go to this CBK Amendment Act. When digital credit started, the Central Bank of Kenya and other kind of regulators argued that because these digital credit providers are not deposit takers, they wouldn't fall under the purview of Central Bank of Kenya. But unfortunately, there was an incidence of someone who committed suicide after his relatives were called, and his wife went to the central banking hall and just basically completely was upset, and that really pushed the central bank to then start, it was just this realization that someone has to do something about this. And because there was no other body, the Central Bank of Kenya developed this Amendment Act. So it was tabled in Parliament in April 2021 and passed in December 2021. There were a lot of negotiations, mainly because the central bank, the initial draft, treated these digital credit providers like banks, who take other people's money. So there were a lot of these capital prudential ratios which shouldn't really apply to them. In summary, the central bank dropped those but became the main regulator for all digital credit providers. What we show is that the consumer protection provisions of this act are not strong. And what we show now is there are a lot of capacity issues. The Central Bank of Kenya moved from being a regulator of 45 banks to now all of a sudden having these 401 applications currently of different digital credit providers. So as of March 2024, they had only approved 32 licenses of 401 applications. But if you'd applied, you could still operate. So this really highlights a key problem with this regulation. And actually, as of 2025, there are a few more that have been licensed, but even more applications. And what we argue is these regulations kind of reinforce this false dichotomy. So there were no further regulations for what were considered already regulated. So banks are regulated by the CBK under the Banking Act, and payment service providers like Safaricom are regulated by the CBK under a Payment Service Providers Act. So neither banks nor Safaricom or other payment service providers had any more regulations on them. Yet, and this is the key thing, 90% of the digital market is controlled by these regulated lenders. And Fuliza, which is like an overdraft facility, which I mentioned was started in 2019, now lends more in one day than a medium-sized bank could lend in a whole year. This act has had some positive changes, like you can see some fintechs have even changed their marketing to say they're being regulated by the central bank. Hatuta kuanika means we won't let you hang out to dry, basically confirming that actually we're maybe not going to share your data. So there have been some positive effects of this CBK Amendment Act, but we argue that by really reinforcing this false binary that the previously unregulated needed no further regulation and only focusing on the new fintechs, this regulation does not really go far enough. And we feel that after President Ruto came in, there have been a few more kind of reforms on the side which actually reinforce our argument. So just after the president was inaugurated in September 2021, Safaricom and its partner banks, KCB and NCBA, announced that it would cut daily charges of Fuliza. And you could see that this was just like some sort of like PR move, some sort of kind of reading the market, seeing that, okay, there's a lot of anti kind of Fuliza sentiment, but Fuliza wasn't affected by the act, but they reduced the rates. But this shows you that this is not really, these sort of one-off things don't really reform the market as a whole. And then the CBK introduced two other press releases, the Credit Information Sharing Framework and the Credit Repair Framework. And the Credit Information Sharing Framework was something that was supposed to clean out this blacklisting of people. And the Credit Repair Framework was something that was forcing banks or forcing digital credit providers to reach out to borrowers and forgive half the loan. But there's our argument is that these show that the CBK Amendment Act is not enough because there are all these other things coming now. But also there's very little evidence that the CIS framework or the Credit Repair Framework was really enacted by banks. To just give you an idea of what I said, of the strength, if you look at these three products, so it's very hard to get any data on these fintechs, because they're private companies, the CBK has not released the data, but these estimate that 90% or over 90% of the digital credit market in Kenya is controlled by bank fintech partnerships is in this graph. And you can just see the top line as Fuliza is just growing dramatically every day. And KCB Money and Mshwari, which are the other two products, they kind of stay the same, but they're also like quite significant. So why did the legislation take the shape it did? What we argue is this is not a simple story of regulatory capture. We did not find evidence of explicit lobbying by Safaricom or banks. And we argue that its structural power, which is high for both Safaricom and banks. The KRA consistently awards Safaricom as the top taxpayer with between 9 to 10% of Kenyan tax revenue coming from one company. And the banking sector accounts for over 36% of taxes in Kenya in 2022. You may have seen from other work, but particularly of my colleague Mariano Oma, is Safaricom is key also for government infrastructure, including social payments. And the ideology of the Kenyan government, which is very much linked to, this need to digitize, the need to, signal that we are always open for business, is linked to this idea of why the legislation took the shape it did. So how meaningful? This regulation, we argue, does not resolve the larger structural problems, including the high cost of credit. So what are the conclusions? So it was a very fraught journey of regulating digital credit. Whilst, I strongly feel that all regulation should be context specific, but there's no global standard even on what regulation should be, credit regulation should be, and that is a challenge. And we argue that there was so much effort behind the CBK Act, but the majority of the market is not affected, and that's because of the structural power of banks and Safaricom. And we argue that this regulation is simultaneously too narrow, so there's a lot of consumer protection issues, but too broad, because even more traditional, say, microfinance institutions that didn't do algorithmic-based lending like digital credit providers, but only used mobile money to, say, distribute a loan, have been affected. So the CBK has now ended up being this regulator of this huge number of institutions that it doesn't have the capacity to do. And building institutions takes time. I'll leave the policy suggestions for now because I've been told that I'm running out of time and it's dark outside. So, but thank you very much for your time.
Thank you very much, Professor Rada, for this insightful presentation. I would like open to discussion. So if you have any question, please raise your hands.
Should I start? Am I first? Should I go ahead? Okay. Well, yeah, fantastic panel, really fascinating presentations. And, sorry, fantastic panel, really fascinating presentations. Sorry. And I have a question for, well, Francisco. Really excellent. I really enjoyed it. And I'm wondering, but just to push it a bit, what you identify as the factors like thin secondary markets and so on as limiting the effectiveness of monetary policy, could those actually be conceived more as symptoms of an underlying structural problem rather than the causes of what's going on? And in that sense, I'm just wondering if you've considered or why you don't bring in external constraints into your consideration insofar as in these types of situations. I mean, if you think of like Jose Antonio Ocampo with the sort of balance of payments dominance of the macroeconomics, the argument is precisely that it's the external constraint that sort of kicks in and restrains the effects of any of these variables before they can even get to that type of domestic monetary effect in that sense. And so it wouldn't necessarily change your conclusions, but I'm just wondering how you would analyze that, how you'd bring it into your model. And then also on Raja, is that it? Yeah. I'm just wondering, in terms of also to kind of connect it to Francisco's presentation, are these fintechs, are they actually like financial institutions in the sense of creating liquidity? Are they actually institutions that create liquidity, or are they working more from a sort of fractional reserve banking type of logic? And how do they actually interact with and influence the monetary policy variables that Francisco was talking about?
Bonsoir. I want to ask my question in French for the first presentation. Thank you for your presentation. Ma question sera adressée au premier intervenant. C'est pour demander quel... Ok, thank you very much. C'est pour demander... Quelle est la stratégie, quelle est la diplomatie du PAS, d'Africi Bank pour les banques centrales? Parce qu'elles visent les banques centrales. Par exemple, elle est à la BCAO pour que les pays africains d'expression française qui utilisent le CFA, les 8 pays de l'UEMOA, puissent au moins adhérer au PASS. Mais de nos jours, il n'y a pas encore de pays. La BCAO n'a pas encore donné son quitus pour que ces pays, mais ces banques centrales, ces banques centrales adhèrent au PASS. Donc la question c'est, quelle est la diplomatie d'Afrique Bank pour que ces banques centrales puissent adhérer au projet PASS? Parce que quand on regarde un peu les chiffres, c'est les banques centrales d'expression anglaise, comme le Nigeria avec Zénith, comme le Ghana ou bien le Kenya, mais les pays africains d'expression française qui utilisent le CFA, comme l'UEMOA ou bien la CEMAC, ils sont un peu absents. Donc, quelle est la stratégie derrière ça pour que les pays adoptent le PASS? Merci beaucoup.
Thank you very much. I had a question for Professor Rada. On the, I guess, the sort of the political side of the story. I'm wondering, what are the conditions for the kind of politicization of this question of usurious credit? You mentioned the story of the widow who goes and, you know, protests at the central bank, and you mentioned that this issue made it into the speech of Retiro. But I'm wondering, is there, beyond this particular dramatic event of the widow who goes to the central bank, is there a longer or wider story of political mobilization around the question of usurious credit? Only because I'm doing research in Senegal around some similar questions, but it's a question which politicians sometimes take up, but that doesn't really become a politicized, broader social question. So I wonder if you could tell us a bit more about that. Thank you very much.
Merci de m'avoir donné la parole et félicitations aux présentateurs pour votre belle présentation. J'avais une question à poser.
Sorry, pardon, I apologize. Can you speak a little bit louder, please?
Ah, d'accord. Bon, je disais que dans un contexte où l'Afrique, la plupart des pays d'Afrique, ou bien les pays d'Afrique en global, n'ont pas leur propre monnaie. Pensez-vous que on doit avoir notre propre monnaie d'abord et concrétiser le projet de PAPS, ou bien on doit concrétiser le projet de PAPS avec notre monnaie actuelle, par exemple le franc CFA. Et après avoir répondu à cette question, pourquoi?
Okay, thank you very much. I was about to say that there is no French speaking in a French-speaking country. I will switch in French. Juste pour quelques contributions par rapport à la présentation de M. Pérez, parce que je suis banquier, donc j'ai eu à subir exactement ce que vous décriviez, qui n'est qu'une confirmation d'un point de vue empirique de ce qui est connu, que la politique monétaire n'est pas efficace du point de vue de la transmission en matière de taux d'intérêt, ni du point de vue de la jugulation de l'inflation. Les raisons pour ça, il y a plusieurs raisons. Peut-être qu'on pourra développer avec vous, M. Pérez, pour peut-être améliorer vos présentations. La première raison, c'est la quantité de monnaie qui est offerte par la BCAO. Si vous comptez à peu près 6 000 milliards sur 136 banques, vous voyez, ça fait à peu près quarantaine de milliards. Et 40 milliards, ça ne représente rien par rapport au total bilan de banques qui ont 1000 milliards de total bilan. Vous voyez, ça ne pèse pas lourd. Le deuxième point, c'est les banques, l'instrument de refinancement que l'on peut utiliser à la Banque centrale, c'est des titres. Ces titres ne sont pas utilisés dans ce qu'on appelle le open market, à savoir que la Banque centrale intervient pour acheter ou vendre des titres. Mais elle utilise les titres comme garantie. Donc, ce qui affaiblit la liquidité du marché secondaire. Parce que lorsque vous avez une partie importante des titres qui sont gelés au niveau de la Banque centrale, ça affecte forcément le marché secondaire des titres. Le troisième point, peut-être sur la structure du système bancaire. Vous l'avez dit, c'est contrôlé par une grosse partie des banques étrangères. Mais pire encore, ce sont des groupes qui sont installés dans les 8 pays. Donc ces groupes installés dans les 8 pays, lorsqu'elles interviennent pour demander la liquidité en refinancement, c'est partagé à l'intérieur du groupe. Donc il n'y a pas de transaction qui se déroule entre des groupes ni des banques. Il se déroule à l'intérieur des groupes, ce qui fausse l'idée de la transmission, surtout au niveau des opérations interbancaires. Et comme je vous disais encore, l'élément le plus important, c'est les titres qui sont utilisés en garantie au niveau du refinancement. Le point aussi que je voulais signaler, c'est que par rapport aux banques, le refinancement pour une banque individuelle, c'est maximum 2,5% de vos fonds propres effectifs, ou à la rigueur 30%, le plus haut entre les 2,5% de vos fonds propres et 30% de votre taille de bilan, qui inclut également les titres. Donc ça fausse beaucoup et ça diminue l'efficacité de la transmission de la politique monétaire. Merci.
All right. Thank you very much for the questions. I think every speaker can have 5 minutes to answer. Maybe we can follow the order of the table here, starting with Professor Cole.
Okay. So starting with the Francophone countries that have the safer zone and PAPs. I think ECOWAS and the AU are working behind the scenes to try and resolve this problem of your inability to join PAPs because you don't have the green light from your central banks. And in the next 1 to 2 years, I believe this will be resolved. And the African Union, through the African Trade Area Secretariat, is taking the lead on this. So I believe they will resolve this soon. Regarding those who don't have a currency or are thinking of their own currency, I think the best thing is to start with PAPs. Then you can roll into your own if you decide not to do safer. But at the end of the day, I think that PAPs should allow us to march towards the one currency that we've been thinking about. So I will encourage you to put more pressure on your political leaders to ensure that they possibly amend and give emphasis to a dual mandate for your central banks to include development. For example, there's no reason why they should be targeting only inflation. They can have a dual mandate targeting both inflation and full employment. Then it will also encourage payments and develop the regulation and protocols for payments in local currencies. Thank you.
Thank you for the questions. Regarding the first question on digital credit, yeah, they do create credit. The key challenge is this credit is too short term and mainly for consumption use. So it's not having any of the sort of transformative effects that you'd expect from, like a higher private credit on GDP ratio. The second question on the monetary policy framework, that's not really my area, but there has been work done by, say, people I know like Jared Osoro. There was a paper by the Jared Osoro and Camilla Talam that was presented at a recent Kenya Bankers Association conference. And they actually show that this the rise in credit is actually helping monetary policy transmission, just because it is increasing competition and the kind of bank lending channel. But in Kenya, there's also been a lot of other efforts by the CBK to, like recently, they're changing the formula that banks use to develop their base rates. So they're kind of multiple mechanisms, but I think the monetary policy transmission channel in Kenya is kind of getting stronger. In terms of the politics, I think it's so interesting because there was all this very kind of anti-digital credit sentiment, but basically anti, like the blacklisting on the Credit Registry Bureau. But you know, the kind of reaction was, we're going to replace it with the Hustler Fund. So the Hustler Fund was a government fund which seemed to suggest that the only problem with digital credit is the price. So if we offer this Hustler Fund at a lower rate, that will solve everything. And there's evidence that there's a paper by Justin Willis and Gala Chome, which compares people's reactions to President Ruto. That time he wasn't president, but his campaign for the Hustler Fund, as opposed to the late Raila Odinga, was the opposition, who was offering a sort of cash transfer, with people saying, no, actually we prefer the Hustler Fund. We don't want free money. We want to work for our money. And yet, most of the Hustler Fund has not been repaid, and it's kind of a bit dead in the dodo. So it's a bit complex. Like the political reaction in Kenya has not been like anti-lending at all. It's more just been like, let us have a bit more fair lending. Yeah, I think those are my thoughts. Yeah.
Once again, thank you all for staying with us deep into the night. To your question, so Andrew, I completely agree that external constraints are very real. I've written 2 papers now looking at the effect of the peg to the CFA's peg to the euro on euro lending, on CFA lending, and I'm curious to what extent the BCI's reluctance to expand its lending is tied to the peg. Although many cynics argue even countries like Ghana and others that have their own currency face the same external constraints, right? So I think that's a very powerful argument, and I think I agree with you. This form of finance for industrial policy is hopefully how you lift that external constraint, right? By producing more import substitution, moving up the value-added chain, and the fact is, when the BCI and other central banks in the region use more direct monetary policies, the credit to GDP ratio was higher, right? We've seen a devolution of financial development in the region, right? It's, I think, only now many countries have caught up to the credit to GDP that they had in 1980. And then, Monsieur, quel était votre nom? Merci beaucoup. No, thank you very much. I mean, honestly, this is what I was hoping would happen, is I wanted to present this work to people who knew the region, who knew the banks. Unfortunately, it's a sad commentary on economics that when I first started researching this question, my first thought was, can I go to Senegal and ask bankers? And economists say, no, that's revealed preference, we don't do that. You read bank reports and you look at spreadsheets and you torture the data into submission. When in fact, I could have, me and many others could learn a lot from just talking to you and others who do this day to day. So I truly appreciate your intervention. Thank you very much. And thank you all for coming tonight.
All right, thank you everyone for staying to the very end, especially to our speakers. I want to ask a last round of applause to everyone, and I wish you all a lovely night.